Now we're going to go a bit further into U.S. data points and really go through what's happening on the jobs front, what are wages doing, and what are some of the benefits and pitfalls and bullish data, bearish data that we're seeing, and kind of how is that going to play out over time. Now, my wife sent me this one because she said that everybody is too bullish and I have been bearish, and clearly that being bearish is actually a good thing if you consider, what the forecasts are and then what the actuals are, where the actuals are typically much worse than what the forecast is. So typically, like as we've been saying, things are a bit. Everyone is the market is priced to perfection right now as we sit at all-time highs, and everyone is feeling good about everything. And though you would assume that some of the good news is priced in at this point, but anytime new news comes out, it's clearly not priced in. All bad news is priced in. All good news isn't priced in. So that's why we continue to get these locksteps higher, which has been fun to watch. And if you don't hate the player, hate the game type thing, and that's fine, and you have to position yourself accordingly to live to fight another day. But these are just some of the reasons why when we look at some of the data points, and as we look at the Fed data, Atlanta GDP estimate keeps coming down. The Fed New York estimate, which we've shown in the past, keeps moving lower. And again, it's coming closer to kind of what our expectations are for Q1, which is still below, I think, what a lot of the estimates are in the market today. Now, as we talk through inflation, and I wrote an article taking a high-level look about inflation, and then we followed it up again with the show last week. But this is an interesting one because when we talk about global manufacturers reporting port or shipping delays, you can see it's still almost 8.5% of the world is seeing some sort of port or shipping delay, and that really isn't going away anytime soon, given the shortfalls we're seeing just throughout the logistical system. And it's starting to get a little bit better, but again, it's still not alleviated completely, and we're still seeing those backlogs at the coast. They're starting to get a little bit better just because we are seeing COVID restrictions get reduced. We're seeing more people show up to work, which is allowing for more movements from the coast, from the ocean into the port, and then from the port into the supply chain that can be spread throughout the country. But again, these are things that are also going to keep prices relatively elevated. And even though we're starting to see some adjustment on the wholesale inventory side, where inventory surprised to the upside, which is something that we had been saying, where we were starting to see a little bit of a normalcy in the general supply chain overall. But again, there's still a price to be paid to get things into market. But again, it's not, and this is where we look at wages. And as we've been saying from the beginning, this is not a COVID story. This is an economic story as we look at the inequality rose as labor share and income decline. So when you look at the 10-year averages as a percent of nominal GDP, wage share in the U.S. economy has continued to move lower. And this is when you think about the riots that we've seen, not just in the U.S. This isn't a U.S. thing. This isn't unique just to the U.S. This is a global problem where the inequality, social mobility is becoming a much starker difference around the world. And this is just a perfect example of that the general separation between U.S. corporate profits and U.S. compensation of employees. And when you have such an elevated level of unemployment, you can pay people less to work because it is now a companies benefit because they can offer you less. And if you've been out of work for 26, 27 weeks, you're more likely to accept less. And again, these are some of those issues that continue to get worse. And we're starting to find a little bit of a bottom. But again, when you look at what happened in 2020 and what continues into 2021, it's actually reversing and getting a bit worse. And this is when we look at, for most of the past few decades, the jobless rate has been above levels economists call full employment. So we had this tightness in the market, but yet we still had wages not matching profits. So just think about that. We were at full employment or below what is deemed full employment, which should have been a benefit for the employee who should have been getting a higher salary because the jobs market was tight, but yet we didn't see that. So again, like how are people going to better themselves and work hard to push forward if they're not getting rewarded to do so? And now this is one of the things when we look at just the sheer shock of unemployment, as we've been saying that it's going to be a much slower grind back to see a lot of these individuals get hired back into the workforce. Now, the JOLTS number came out, and it's a data point that I haven't looked at in a while, and it's my own fault, but the beverage curve is an important one to look at. And because people want to talk about JOLTS and what does that mean versus unemployment rate. So what is this looking at? This is looking at the efficiency of the employment of the jobs market. So as the unemployment rate goes up, or to the right. So if we're looking at the X and the Y axis. So if we're looking at the X axis there. So the X axis, as unemployment rate goes up, the job openings rate should go down because there's less jobs. As unemployment rate goes up, people could, if they could get jobs, they would try to. But when we look at this here, you can see that even though the unemployment rate exploded to the right, we never saw job opening rates go down. So is this more of a mobility issue? And I say that in terms of the ability to go from one industry to another, from one job to another, because now we have job opening rates remaining elevated, but we're still seeing a very big slowdown in terms of, well, what is the employment? Now, is this because the benefits coming from the government outweigh what you would make going to get a job that is a job opening? Is there some of the, I know from my own experience that when I've applied to jobs and either the job goes away, the position is terminated, or there's a hiring freeze at that firm. So I know I've experienced that. How much of that is real versus fake on the job opening side? But I think this is an interesting way to think about the mobility problem that we keep talking about. And I think it's an interesting view. And then, so the Oxford economics company that put this out, Gregory, I think Dacko is his last name, who's a great follow. He put this together and just looking at what happened in previous down cycles. So here you can see just how low, or where the unemployment rate was and where things sit right now in terms of what is the unemployment rate and what were job openings. So when we look at the Great Recession, you can see just kind of where things were between June 2009 and February 2020. Then when we look at the Great Recession, you can see kind of where things were, where there was a natural movement in this area. The job openings rate never dropped below that 3.75%, but yet there's still not a lot of people being hired back. And is it because they're not willing to accept the salary? There's this deviation that is interesting in terms of just where is the breakdown in the market on getting people back to work. And now let's dive into this a bit further. So when we look at the Federal Reserve Bank of Kansas City, the job availability improved over last quarter, but expectations for next quarter are negative. So is there also a delay in terms of what are the job openings saying versus what is actually available? Because things were okay, and now as we look forward, there's an expectation that the next quarter is going to be below and have another contractionary period, because everything that we look at, when we look at PMI, PMI is a cumulative number, and when you think about where are we expanding or contracting, as we've been saying, 50 is nothing. You're not contracting, you're not expanding, you're doing really nothing. You're just keeping constant from the previous month. Where when we look at if you're in 52 to 48, there's a little bit of expansion, a little bit of contraction, but again, you need to fall outside of those levels to really see a meaningful change in the near term, and we just haven't seen that on the employment side, which again is showing just the issues on the inefficiencies within that market. And Indeed is showing something very similar. So Indeed is showing that the job openings are above pre-COVID levels. So when we look at the drop in in job postings, down almost 37%, but we never saw that on the JOLTS side when we think about what is actually moving the market at this point. And here you can see just the bifurcation in the market of what is posted, but then what is actually being filled. And when we think about, well, when you do get a job, well, trends at the wage level veer in different directions. So when we look at the wages or in the diffusion index of industries creating jobs during the month, the wages, the amount of jobs being created for the different wage levels are adjusting. Like when they're all going in the downward trajectory, but the middle and low wage is getting lower and lower, which again creates this bifurcation, or the K-shape as everyone likes to talk about, of the difference between getting a job, finding one, and then if you do find one, at what salary rate or what hourly rate would you be able to get? So then when we look at, okay, well, if you're struggling to get jobs, well, what about those missed payments? Well, we've heard in the market or out of the government talking about forgiving up to $50,000 of student debt. Well, percent of student loan borrowers with missed payments. So clearly there's a lot of people that said, I'm not paying my student loans anymore because you're going to forgive it. So why am I going to pay for it? But if you remember back in 08, 09, there was rules and regulations that said that if you declared bankruptcy, you could not get your let's just say your student loans never went away. Other things would go away in bankruptcy court, but the student loans lasted forever. So now this is where we sit, and this is going to be something that is going to weigh on, well, what's going to be their decision? Because right now we have over $1 trillion in just student loans. And this is going to be an interesting chart to figure out how that plays out. But looking at the headline payroll, because, just looking at those job side as we think about the differences in terms of what people are paying, you can see just the inherent slowdowns and how there's really not any one area that's driving us higher as we continue to just really push sideways and not really getting past this flattening out, which we talked about. Now, December got much worse. November got a little bit worse. And this is what we've been saying, where we were going to have a hard bounce off the bottom and then flatline, just because companies just didn't have the same type of, didn't need as many employees as they were currently had. So that's what is really playing out in this swoosh, or if you will, on whatever that comment that you want to make on it. And some of the unemployment data is going to get a little bit better based on what the early estimates are. So we should see this continue to rise, but again, it's going to be at a very reduced rate. And the other issue, then this comes back down to that JOLTS view in terms of the efficiencies of the market. We're talking about a labor participation rate that is at the lowest since 1977. So you have a certain amount of people that are just, I don't want to work, and I am disinterested in it because I either got a payout, I'm getting too much from unemployment, or I'm done, I'm in my mid-60s, I'm out. This is going to should become something better on the back end because there's less people looking for those jobs, which is why when we look at the different U3, U6 versus where is the unemployment rate really sit, that's why when we talk about the long-term unemployed is the highest since the financial crisis. 40% of unemployed individuals have been unemployed for 6 months or more. Again, talking to savings, how they're burning through savings, how not everybody has that savings cushion that we keep reading all about, as we talked about last week. And then when we look at U.S. labor productivity, we're back down to levels that we saw in the early 80s. And this can come to, well, are you being paid not to work? And that's why people are just sitting at home and collecting a check, which again is impacting just how efficient this jobs market really is. And again, but will stimulus cause a U.S. overheating? Because the data points that they quote, the CPI numbers, the levels that they keep highlighting, are showing that there's no real inflation. But it's being weighed down from airline tickets, from concert tickets, from things that nobody's doing. But when you look at things that people are doing and required to survive, especially the lower third of the country, there's a problem, and there's the difference. And when you look at the ISM manufacturing operation rate, there's some capacity to see some of that manufacturing come back. But some of the data is good and some of it is problematic, especially the jobs and unemployment, which is why, how will that really show through? Because we're seeing banks less and less willing to lend over the last month, because what rate are you getting? What's the reason I'm going to push this into the market? Because I already have a very large bad debt expense. I'm concerned about my balance sheet. So, and I'm not getting compensated to give out money. So why am I going to do that? Which again is leading to liquidity not being the problem, but movement of that money into the system is. But when you can get it, there's U.S. margin debt. So when you see the debt that you can get coming from everything throughout, whether you're trading through Robinhood or TD Ameritrade or Interactive Brokers, U.S. margin debt is growing at the fastest pace on record, because it's very easy for these companies to get that margin and then just pass it through. And guys are going out there and saying, I am going to take advantage and buy calls. And here's your margin debt as a percentage of GDP is continuing to drive higher. And not that it's going to be a huge problem against GDP if all the margin debt goes away, but you're just getting an idea of just how much margin is being consumed, because a lot of this is being done on obviously the large hedge funds, but also at a growing rate at the retail trader. And here's the inflation that we keep talking about. When we look at, well, where is the inflation? More CPI still remains depressed, even though the small business recent price changes, you're seeing all these prices continuing up. And you can see here that a lot of times the recent price changes are a leading indicator to where you're going to get that inflation number. And now there is a certain amount of logistical problems within that. But again, it's more than just logistics. There is a bigger problem afoot that is not going away anytime soon. But when we look at global earnings, so global earnings keep getting revised higher, and you would assume that some of that is priced into the market, but clearly it isn't. And you're getting some of these earnings because the assumption was that there was going to be more pain. Some of these companies have been able to manage that a bit better. And if you look at the jobs data, it's been by shedding a lot of cost and trying to manage their balance sheet to get to the other side. And at the same time, you also had analysts asleep at the wheel and essentially not assuming that things were going to be as good as they were, doing their channel checks. Not quite sure at this point in time. But then when we look at return on equity and free cash flow, you can look at just where we're seeing those benefits: information technology, healthcare, consumer staples, discretionary. That's where we're seeing the return on equity, free cash flow yield remains fairly strong, as energy, utilities, real estate obviously fall to the backside. And it's going to be hard to see that adjust. I mean, obviously energy is being driven higher as an article comes out saying OPEC stands to regain 35% of crude oil market share by the end of the year from a low of 32% this past June. Well, we'll see how that plays out. But again, this is where we see energy at this point. And that's why it's also not surprising to see the VC-backed companies going public, because there's a lot of liquidity out there. There's a lot of demand in the market. So let's do IPOs. Let's do SPACs. Number of IPO exits. You can see the sheer size of stuff happening at the back end of 2020 as things normalized a bit from COVID. And there was just so much liquidity out there that it's obviously going into the public markets. And now that we've looked at that, well, where is it being pushed? Well, technology services, commercial services, health technology. Again, the things that are yielding the best returns is obviously getting the most VC investment by sector, as you can see kind of where that setup lies. And if you think about the sector breakdown of U.S. private equity entries, it is not surprising to see it at healthcare and information technology. Again, because that is where we're seeing those returns and people are trying to focus and push their money into to go to work. Then when we look at obviously CPI, we've seen that coming in below estimates, but again, we keep talking about what are the pitfalls of where that sits and what is the issue, and what we have that article, and last week we covered it in more detail. The bigger issue is going to be average weekly earnings continued to move up, hourly earnings moved up, but you're not seeing that turn into more employees being hired, you're still seeing just the same employees doing more and getting compensated for it. So again, just trying to do more with less. But the wholesale inventories month over month continue to move higher. Again, trying to get to a more balanced setup where wholesale trade sales, you can see in prior was 0.2%. We're now at 1.2%. That will get better through January as well. Now, we just wanted to end out this segment talking about Bitcoin and some of the other components. But before we get into that last piece, we want to look at what is the slowdown in search activity. So when we think about what people are doing, you're seeing people Google search for things less and less as we go through January. For services, for industrials, again, these are things that are just showing that on a leading indicator, there's just less happening in the world right now, specifically in the US, as people just aren't searching. They're just comfortable where they are. They're trying to hold firm, maintain the lifestyle they have while they let the world normalize around them. Now, we did a segment on, we talked about Bitcoin and what was happening with Bitcoin. And we said that there was a weightings towards, where 5% of the wallets controlled most of the Bitcoins. And this was a great article explaining how that's not really the case and you have to get more nuanced. So we'd like to get more nuanced as well. And what does that mean? So where do we see the largest percentage of ownership of Bitcoins? Well, let's just look. And this is using the coastal moves. So miners own about 9.7% of Bitcoins, just given their mining process, their rewards for doing that. The exchanges in general have about 12.7%. That's liquidity. That's their own, some of the exchanges have some mining capacity. Again, there are some components of where this sits. Now, the exchanges is where we keep seeing some of this redundancy of double counting and these backdoors that are being created. That's where there's some uncertainty as to what is the full liquidity in these markets. But then the humpback, which are people that own more than 5,000 Bitcoin, is 13.3% of that market, where whales who are those that own 1,000 to 5,000 is 18.4%. And then you get down to the shark, which is 500 to 1,000, which is 6.6%. So you can see that it's a bit more, there's a bit more openness in terms of who owns what. But the question is, if a whale, let's just use the whale for an example, goes to sell 5,000 Bitcoins, is there going to be enough of a market to absorb that, or are we going to find air pockets where it'll snap down, then snap back up? These are things that just make it difficult to, and the volatility is obviously increasing exponentially. But this gives, I think, an interesting kind of dynamic as to where is this within the market. And then looking at the Glassnode, because where it was looked at is cumulative change in supply ownership across entity size. So you can buy fractionals, you can do different things. So when we look at who has gotten involved, we've seen an increase in the shrimp and crab side, which is that, who are they? They're the ones that own less than 10 Bitcoin. So a crab owns 1 to 10, a shrimp owns less than 1. So you can see that they have become a much bigger part of this market. So when you look at the movement higher in Bitcoin prices, it has come as the smaller entities and the tiny entities have been buying up whatever they can on whatever volume is there. And given the limited amount of selling happening from the whales, humpbacks, dolphins, sharks, the bigger guys, they're just chasing a small pool. So that means that if all of a sudden one of these humpbacks decides to dump all of their capacity, well, is there going to be enough of those shrimps and crabs that are going to rush in and buy more, or are they going to be blown out because it's now gone below where their price is and they're scared? And again, if you're not confident in what you own, you might have a risk of just saying, look, I'm done. So these are some nuances as the liquidity moves from the bigger hands into the smaller hands and getting a bit more functional within the market. It's going to be a very volatile move up and down, just given on who has the liquidity at that moment in time. So these are things that we'll continue to look at as Bitcoin becomes the commodity that everybody likes to talk about so much. I won't say, obviously Tesla bought some. They're talking about exchanging Bitcoins for cars, which one Bitcoin being $40,000, $45,000. Buying a car for one Bitcoin is easy. Buying a $3 coffee for a fractional Bitcoin, that becomes more complex. So on the larger scale, obviously you can see how it might be a bit easier, but those are things that we'll discuss in a different show, looking at the holistic supply chain of smart contracts versus the overlying currencies, because I think the smart contract has a lot of value versus what the overarching currency is doing. So again, or commodity is doing in general. So that's all we have for you in this segment. In the next segment, we're going to go through in more detail, looking at the bifurcating economy and more into what is happening in real estate, and a bigger deep dive into, or an update into, what is the real estate market today.